So you've got a business idea, right? Maybe it's scribbled on a napkin. Maybe it's a full-blown plan. But the first question is always the same. Can this thing actually make money? Well, today, we're going to break down a really powerful tool called cost volume profit analysis. Think of it as the secret sauce for finding that exact tipping point where your dream starts to become a profitable reality.
I mean, this is the million-dollar question, isn't it? Doesn't matter if you're selling t-shirts, coding an app, or opening a coffee shop. You have to know the absolute bare minimum you need to sell just to cover your costs. That number, that's your survival threshold. And we're about to figure out exactly how to find it. And the official name for this tipping point is the break-even point. It's the whole focus of our analysis today. And honestly, it's the first major milestone for any new business.
So what is it exactly? The break-even point is that magic moment where you're not making a profit, but, and this is crucial, you're not losing money either. Every dollar you've spent is perfectly matched by a dollar you've earned. Believe me, for any new company, hitting this point for the first time is a huge deal. Okay, so to find that break-even point, we first need to understand what our costs are actually made of. And it turns out not all costs are created equal. They fall into two totally different categories. And knowing the difference, well, it's the key to everything.
Let's imagine we're starting a t-shirt business to make this super clear. Your fixed costs are things like the rent for your studio. You got to pay that every month, whether you sell one shirt or 1,000 of them. It's fixed. Now, on the flip side, you have variable costs. These are tied directly to each sale. Every time you print a shirt, you have the cost of the blank shirt itself and the ink. So the more you sell, the higher your total variable costs are going to climb.
And here's the really clever part of this whole analysis. We actually rearrange the atypical income statement. Notice how costs aren't grouped by department, like marketing or sales. Nope, they're grouped by how they behave. All the variable costs get lumped together, and all the fixed costs get lumped together. This special format is what clears a path right from your sales all the way down to your profit. Okay, we've got our costs sorted into two neat piles. Now we can find the single most important number in this entire process. It's called the contribution margin, and you can think of it as the engine that powers your business towards making money. Here's how it works. Every single time you sell something, a chunk of that money immediately goes to cover the variable costs for that one item. Whatever's left over, that's the contribution margin. This is the money that does all the heavy lifting. First, it chips away at your fixed costs like your rent. And once those are all paid off, every single cent of contribution margin from then on is pure profit. And that's when the fun begins. So back to our t-shirts. If you sell a shirt for, say, $25, and the blank shirt plus the ink costs you $10, your contribution margin is $15. That's $15 from every single sale that goes straight towards paying off your studio rent. All right, this is it, the moment of truth. We have all the pieces of the puzzle. We know our fixed costs, and we know our contribution margin for each unit. We are officially ready to calculate the exact number of t-shirts we need to sell to break even. The logic here is actually beautiful and simple. First, you figure out the total mountain of fixed costs you have to climb each month. Second, you figure out how much cash each sale gives you, your contribution margin, to chip away at that mountain. And then, you just divide the size of the mountain by the size of your shovel. And here is the formula in all its glory. You just take your total fixed costs and divide them by your contribution margin per unit. So if your monthly rent is $1,500 and your contribution margin per shirt is $15, you divide 1,500 by 15. The answer? 100. You need to sell exactly 100 shirts to break even, not 99. 100 is the magic number. This graph basically tells the whole story visually. See that red area on the left? That's the loss zone, where your total costs are higher than your revenue. Not fun. But then, see that exact spot where the lines cross? That is your break-even point. From that moment on, you enter that beautiful green profit region. Every single shirt you sell past that point puts pure profit right in your pocket. But look, just knowing your break-even point, that's only the beginning. The real power of this analysis is using it to make smart, strategic decisions about where your business is going.
Breaking even is great, but let's be real, it doesn't pay the bills. You got into business to make a profit. So how does the math change if you have a specific goal in mind? What if you want to make, say, $1,000 in profit this month? And check out how elegant this is. You just take your original formula and you add your target profit right on top of your fixed costs. You're basically treating your profit goal as just another fixed cost you need to cover. So to make that $1,000, you need to cover your $1,500 rent plus your $1,000 profit goal, all with that $15 contribution margin from each shirt. This leads us to another super important idea, the margin of safety. If your break-even point is 100 shirts, but you're actually selling 150, your margin of safety is 50 shirts. It's your buffer, your cushion. It tells you exactly how much your sales could drop before you're back in the danger zone. The bigger that margin, the better you can sleep at night. And this is where CVP becomes a really powerful strategic tool. Check out this trade-off. You could run your t-shirt business with a manual system. Your fixed costs would be low, but your variable costs for each shirt are higher. That gives you a nice low break-even point, which is less risky, but it also kind of caps your profit potential. Or you could go all in on a big automated system, a huge fixed cost, but tiny variable costs. Now, the break-even point is scarily high, but man, if you can get past it, the profit potential is massive. This analysis lets you model these critical choices before you spend a dime. So, to wrap it all up, cost volume profit analysis isn't just about finding that one static number. It's a dynamic tool. It helps you set profit targets, it helps you understand the deep relationship between your costs, your sales, and your profit, and most importantly, it helps you manage your risk and see the true potential of your idea. So there you have it. You have the tool, you have the formulas, the concepts are simple, but what they can tell you is profound. So, the only question left, and it's the one that really matters, is what's the tipping point for your big idea?